silver investors aren't ready for what's coming next. Something is quietly breaking in the silver market. Not loudly, not with headlines, not with panic. Quietly. And by the time most investors figure it out, the window will already be closed. Right now, as you watch this video, there is a structural imbalance forming in silver that hasn't existed at this scale in over 4 decades. The kind of imbalance that doesn't correct gently, the kind that snaps. And most retail investors, even experienced ones, are completely unprepared for what comes next. Stay with me, because what I'm about to show you changes the entire framework of how you think about silver. Here's what this video is actually about. It's not about silver going up or down next week. It's not about a trade. It's not a price prediction. What I'm going to walk you through today is the structural architecture of a supply and demand crisis that is already in motion, one that is being powered simultaneously by industrial forces, monetary forces, and geopolitical forces that have never converged like this before in modern history. By the end of this video, you're going to understand 3 things that most silver investors either don't know or refuse to believe. First, why silver's supply deficit is no longer a talking point. It's a mathematical reality. Second, why the Federal Reserve's next move may be the single biggest catalyst silver has seen since the Hunt brothers nearly cornered the market in 1980. And third, why the countries that are quietly exiting the US dollar system are stockpiling the one asset that cannot be printed, sanctioned, or frozen. Most people hear silver and they think jewelry, or coins, or maybe a hedge. Smart money is starting to see something very different. Let's get into it. Section 1. The deficit nobody is talking about. Let's start with the supply side, because this is where the story begins, and it's more alarming than most people realize. For the past 4 consecutive years, the silver market has run a structural supply deficit. That means the world is consuming more silver than it is mining, every single year. Now pause on that for a second. If any other commodity on Earth had run 4 consecutive annual deficits of this size, it would be front-page news. Analysts would be screaming about it. Funds would be repositioning. But silver? The financial media is largely silent. Why? Because silver has historically been treated as a monetary metal, a store of value, a speculative trade, something you buy when you're afraid. And when people frame it that way, they miss the industrial revolution happening underneath the surface. Here's what's actually driving the deficit. Solar panels, electric vehicles, AI, data centers, defense electronics, medical technology. Silver is not optional in any of these industries. It's not replaceable. It's not something engineers can swap out for a cheaper alternative. Silver has the highest electrical conductivity of any element on the periodic table. It has unique antibacterial properties. It's essential in semiconductor fabrication. It's embedded in every advanced circuit board being manufactured today. And the scale of this industrial demand is genuinely staggering. The global solar industry alone is now consuming over 200 million ounces of silver per year. That number was under 50 million ounces just a decade ago. Solar has quadrupled its silver consumption in 10 years, and the build-out is accelerating, not slowing down. The International Energy Agency projects that global solar capacity needs to triple by 2030 just to meet climate targets. Triple. From a base that is already consuming silver at record pace. Meanwhile, total global silver mine supply has been essentially flat for several years. You cannot simply decide to open a new silver mine. The average time from silver discovery to first production is between 10 and 15 years. The pipeline of new supply is thin, and the existing mines are getting older and deeper, which means higher costs and lower grades. So you have demand that is structurally rising on a near vertical curve, meeting supply that is structurally constrained. That's not a trading opportunity. That's a geological and industrial collision that takes years to resolve. And right now, we are in the early stages of that collision. Section 2. Above ground stockpiles, the hidden pressure valve. Now here's where the argument gets more uncomfortable. Some analysts will tell you the deficit doesn't matter because there's still silver sitting in warehouses. There are still stockpiles. The world isn't running out tomorrow. And technically, that's true. But here's what they're not telling you. The above-ground stockpiles of silver that are actually available for industrial use, not held in investment products, not sitting in private vaults, not locked in financial instruments, are being drawn down at a pace that has alarmed the few analysts paying close attention. COMEX registered silver inventories, the silver that is actually available for delivery and industrial purchase, have experienced significant drawdowns over recent years. We've seen stretches where registered inventory dropped to multi-year lows, creating genuine questions about physical availability at quoted paper prices. And this raises a question that most financial analysts are uncomfortable asking out loud. What happens when the paper price of silver, the price set on futures exchanges by traders who mostly never take physical delivery, diverges significantly from the physical price that industrial buyers actually have to pay? This isn't a hypothetical. It has happened before. In 2021, we saw physical silver premiums spike dramatically above spot price during a retail buying surge. Dealers ran out of product. Mints had waiting lists months long. That was a relatively small retail event. What happens when the same dynamic hits the industrial side? When solar panel manufacturers in China and Germany and Texas are competing for the same dwindling physical supply? The paper price is set at the margin by leveraged futures traders. But the real price, the price that matters to the physical world, is set by who actually needs the metal and how badly they need it. If these current deficit trends continue, the math begins pointing toward a physical silver squeeze that the futures market is structurally unprepared to handle. Section 3. The Federal Reserve, the catalyst hiding in plain sight. Now let's talk about the monetary side. Because the supply story alone is powerful, but it's the macro overlay that makes silver's potential setup almost historically unique. Let me give you the framework first. Silver is a hybrid asset. It's the only major commodity on Earth that simultaneously functions as an industrial metal and a monetary metal. It responds to both economic growth because industry needs it, and monetary debasement because people flee to it when they don't trust currencies. This dual nature means that silver tends to do well in two very different environments: strong economic expansion that drives industrial demand, and monetary crisis that drives safe haven demand. Right now, there is a serious argument that we are entering a period that could deliver both. Here's why. The Federal Reserve spent 2022 and 2023 executing the most aggressive rate hiking cycle in 40 years. They took interest rates from near zero to above 5% in roughly 18 months. And for a while, it worked, in the sense that inflation came down from its peak. But here's what that aggressive tightening left behind. The United States is now carrying over $36 trillion in national debt, and at current interest rates, the annual interest payment on that debt has crossed $1 trillion per year. $1 trillion just in interest, not paying down the principal, not funding infrastructure or defense or social programs, just keeping the lights on, financially speaking. This is not sustainable. Every serious economist knows it. The Federal Reserve knows it. The Treasury knows it. The only historical escape routes from this kind of debt trap are default, which no government voluntarily chooses, severe austerity, which no democratic government can politically survive for long, or inflation, allowing the purchasing power of money to erode so that the real burden of the debt shrinks over time. History is not ambiguous about which path governments tend to choose, and here's where it connects directly to silver. When governments inflate their way out of debt, when they allow real interest rates to fall deeply negative, when they quietly debase the currency, hard assets historically perform. Gold first, silver shortly after, and often with significantly more explosive price action because of its smaller market size. The gold-silver ratio right now remains historically elevated. For most of monetary history, gold and silver traded somewhere between 15 and 30 ounces of silver to buy 1 ounce of gold, reflecting their natural occurrence ratio in the Earth's crust. Today that ratio is significantly higher, meaning silver is historically cheap relative to gold on a monetary basis. When monetary conditions shift, when the Fed pivots, when real rates fall, when the dollar weakens, silver has historically closed that gap aggressively. Not gradually, aggressively. In 2020, when the Fed went to zero and launched quantitative easing, silver went from under $12 to nearly $30 in just a few months. That's a move of over 150% in under a year. Now consider, what happens when the same monetary catalyst hits a market that is also experiencing a structural industrial supply deficit? Those two forces don't add, they compound. Section 4. De-dollarization and the geopolitical dimension. But there's a third dimension to this story that almost nobody in Western financial media is connecting to silver, and it may ultimately be the most powerful force of all. We are living through the early stages of a global monetary realignment. It's slow, it's messy, it's incomplete, but it's real. The BRICS bloc, Brazil, Russia, India, China, South Africa, and now an expanding roster of additional members, represents a coalition that now accounts for a larger share of global GDP than the G7 on a purchasing power parity basis. And this bloc is actively building financial infrastructure to reduce dependence on the US dollar. Cross-border trade settled in local currencies, alternative payment systems, new clearing mechanisms, central bank gold purchases at a pace not seen in decades. Here's the key insight. When countries are trying to build a reserve system that doesn't depend on another nation's currency and political goodwill, they need assets that are nobody's liability. Assets that can't be frozen. Assets that can't be sanctioned. Gold is the obvious choice. And central bank gold purchases have reflected exactly that logic. But gold has limitations. It's expensive. It's not easy to use in everyday trade settlement. It doesn't scale quickly. Silver, particularly in Asian markets, in India, in Middle Eastern sovereign wealth contexts, has historically served as the accessible monetary metal. The silver that ordinary economies and ordinary people store and use when they lose faith in paper systems. India's silver imports have reached record levels. China's domestic silver demand is running at historically elevated rates. These are not speculative purchases. These are long-term structural accumulations. And here's the uncomfortable question. If the dollar-based global financial system continues to fracture, even slowly, even partially, and if the countries exiting that system are simultaneously the countries driving the industrial demand for silver in solar, EVs, and electronics, then you have a single metal being pulled by three separate forces at the same time. Industrial demand from the green energy revolution, monetary demand from currency debasement and debt crisis dynamics, and geopolitical demand from nations actively building non-dollar financial reserves. Show me another asset on Earth facing that trifecta right now. Section 5. Why most investors are unprepared. So if the setup is this compelling, if the supply deficit is real, the monetary conditions are aligning, and the geopolitical context is strengthening, why aren't more investors positioned in silver? This is where it gets psychologically interesting. Silver suffers from what behavioral economists call the familiarity discount. It's been around forever. People have heard silver bulls make their case for years. There have been false starts, 2011, 2016, 2020. Every time silver looked like it was breaking out, it got pulled back. And every failed breakout trained another generation of investors to treat silver as a forever almost story. But here's what those investors are missing. The structural conditions that existed in 2011 or 2016 are not the conditions that exist today. The industrial demand picture is categorically different. The geopolitical landscape is categorically different. The debt situation in the United States is categorically different. The past false starts happened when silver was primarily a monetary trade, a bet on inflation, or Fed policy. Today, silver is simultaneously a monetary trade, an industrial necessity, and a geopolitical hedge. The demand base has been fundamentally transformed. And there's another psychological trap. Most retail investors look at silver's dollar price and compare it to gold and think, I'll just buy gold. It's more prestigious, more serious. But that logic ignores the asymmetry. Gold's market cap is roughly 15 times larger than silver's investable market. When institutional money starts flowing toward precious metals, and there are early signs this is beginning, a relatively small reallocation into silver creates a much larger price impact simply because the market is so much smaller. The same dollar flow into silver moves the price dramatically more than the same dollar flow into gold. This is not speculation, this is basic market mechanics. And right now, institutional silver positioning remains historically low. The move, if and when it comes, will not be driven by retail investors who already own silver. It will be driven by institutional capital arriving late, chasing a market that is already supply constrained. When large buyers enter a small supply deficit market simultaneously, the price discovery that follows is not gentle. Section 6. The timing question. Now let me be direct with you about something that most finance channels won't say honestly. Nobody knows the exact timing. Anyone who tells you silver will be at a specific price by a specific date is either guessing or misleading you. Markets are complex systems influenced by thousands of variables. Timing is always the hardest part of any macro thesis. What I can tell you is this. The conditions for a structural re-rating of silver prices are more aligned today than they have been at any point in the past several decades. The supply deficit is documented. The industrial demand curve is visible and accelerating. The monetary pressure is mathematical. The geopolitical trend is structural. These forces don't resolve in a week or a month. They build, and then, typically triggered by some catalyst that seems obvious in retrospect, a Fed pivot, a dollar crisis, a supply disruption at a major mine, a sudden spike in industrial demand, they release. Historically, when silver makes a major move, it moves fast and it moves far. The 2010 to 2011 run took silver from roughly $18 to nearly $50 in just over a year. The 2020 run was sharper and faster. These were not slow, grinding climbs. They were rapid, violent repricing events. The investors who benefited from those moves were not the ones who tried to time the exact entry. They were the ones who understood the structural thesis, positioned accordingly, and held conviction through the noise. The investors who missed those moves were the ones waiting for more certainty, who wanted to see the move already happening before they committed. And by the time certainty arrived, the opportunity was already largely realized. This is not investment advice. Every person's financial situation is different. You should always do your own research and consult a qualified financial professional before making investment decisions. Past performance does not guarantee future results, but as a matter of structural analysis, the setup deserves serious attention. Let me leave you with this. We are living in a period of extraordinary monetary stress, accelerating industrial transformation, and fragmenting geopolitical order. Every one of those forces is touching silver, not indirectly, not theoretically, directly. The supply deficit is real and growing. The monetary debasement pressure is mathematical and building. The geopolitical accumulation is happening right now, in real time, measured in hundreds of millions of ounces. And the majority of retail investors in the Western world have a near zero allocation to the one hard asset sitting at the intersection of all three of these forces. So here's the question I want to leave you with. If the conditions I've described tonight continue to develop, and the structural data suggests they will, what does the world look like in 3 years for an investor who understood this early versus one who was waiting for the mainstream narrative to catch up? Because by the time silver is on the cover of financial magazines, by the time your neighbor is asking you about it, by the time the institutional analysts are raising their price targets on CNBC, the window will already be closing. The opportunity is not in the crowd. It never is. It's in understanding what the crowd doesn't see yet. Stay sharp, stay patient, stay informed, and I'll see you in the next one.